Okay, we're going to look at notes receivable. Okay, this is when we either sell an item to a customer and they finance it, in other words, they're borrowing, or we're simply loaning them money. Now, in this example, on September 1st, a customer borrows $140,000 at an interest rate of 8%, and interest rates are always annual interest rates, unless it specifically states otherwise, and the loan is for 9 months. So there are 3 journal entries that we're concerned with. On the date that we loan the customer money, and I'm going to abbreviate, we are going to debit notes receivable for $140,000, and we're going to credit cash for $140,000. And I'm going to create a T account here to remind us that when the customer pays back the note, we got to get rid of the note receivable. Okay, that's an easy journal entry. Now, on December 31st, the end of our fiscal year, end of our business year, under accrual basis accounting, we have to record the amount of interest revenue that we have earned. So if they borrowed money on September 1st, September, October, November, December, we have earned 4 months interest. So let's calculate interest. $140,000, we call this the loan principal, times the interest rate, would be $11,200 of annual interest. That's if the loan were outstanding for a full year, but it's not. So let's figure out monthly interest. So we divide the annual amount, 11,200, divided by 12 months, and that gives us $933 of monthly interest. Now, they borrowed the money on September 1st. It is now December 31st, year end. We have to prepare financial statements. So we have to accrue 4 months interest, even though we're not going to get paid until the end of the 9-month loan period, which we call the maturity date, which is on June 1st of the following year. But we still have to accrue 4 months interest. So $933 monthly interest times 4 months would give us $3,733. By the way, if we wanted to, we could calculate daily interest instead of monthly interest. We'd simply divide the annual interest by 365 days, or more commonly used by banking, 360 days. Okay, and that would give us daily interest times the number of days in the month that have gone by from September through December. Okay, so we have to accrue $3,733 of interest. We've earned it, even though we're not getting paid until the following June 1st. These are the rules of revenue recognition in accrual basis accounting. So I'm going to debit interest receivable for $37.33, and I'm going to credit interest revenue for $37.33. This is an adjusting entry. Interest receivable is an asset, a current asset. It's going to go on the balance sheet. I'm going to put that up here, $37.33. And interest revenue is a revenue account that goes on the income statement. Now remember, interest revenue, like all revenue accounts, gets closed out, gets set back to zero at the end of the year, December 31st. Interest receivable is an asset. It does not get closed out. It sits on the books until we collect the money, and at that point we get it off the books being our accounting records. Okay, so we accrued $37.33 of revenue that was recognized in the year 2015. Now in the following year, the maturity date of June 1st, 5 months of interest will be earned. So if I were to take my monthly interest of $933 right here, times 5 months, that will give me $4,665 of additional interest that we're going to earn in the following time period. Now, it is now June 1st, the due date or maturity date, same thing, and we are going to collect all money owed to us, which is the principal of $140 plus 9 months interest. Okay, and so I'm going to debit cash for $148,398, which again represents $140,000 of principal and $8,398, which represents 9 months interest. Now that we've collected the note, we have to get it off our accounting records, or else we're going to think that they still owe us the money, and they don't owe us the money. So I have to credit the note receivable, and I'll do that here. NR, note receivable, credit 140. I'm going to do the same thing with this interest receivable. This is that amount we accrued at the end of the year for 4 months interest. I'm going to credit interest receivable for $37.33. I'm going to abbreviate here. Interest receivable $37.33, and then the last thing I'm going to record is the 5 months of interest revenue that is earned in the following time period, which is $4,665. Okay, and so you have to remember that in accrual basis accounting, even though we're not going to collect till June 1st, 2016, at the end of 2015, before we prepare financial statements, we have to recognize, and recognize simply means record, the amount of interest we earned in this time period, which happened to be 4 months or $33,733. And so to recognize revenue, I debit an interest receivable account, because again, I have not yet collected this amount, and I credit the interest revenue, and that makes sure that this amount goes on the year 2015's income statement. On the maturity date, when we are going to collect all the monies owed to us, the note of 140, the principal, plus 9 months interest, and if you multiply 933 times 9 months, you should get $8,398. I debit cash for $148,398. Then I have to get the notes receivable off my accounting records. So I credit the note receivable for $140. I have to get rid of that interest receivable. Well, it's just sitting there. So I credit interest receivable for $37.33, and then I have to recognize 5 months interest revenue that was earned in the following time period. 5 months times 933 is $4,665. So we recognized a total of $8,398 in interest revenue. However, $37.33, which is 4 months, was recorded in the year 2015, and $46.65 was recorded in the following time period, 2016. Okay, and that's notes receivable.